Good morning, everyone. Thank you so much for joining us today. My name is Hajra Talat, and I will be your host for this webinar on VAT audit preparations and compliance with the regulations in the UAE. So, before we dive into the session, let me provide a brief introduction about our company, ACME Group. ACME Group has established itself as a trusted tax and financial solutions provider across GCC region and Egypt. We are committed to delivering high quality solutions tailored to the needs of various businesses across different industries. Our focus on quality and expertise has allowed us to build long term relationships with our clients. Our exceptional team consistently delivers value efficiently, making us the preferred service provider in the region. So now, let me introduce our esteemed speaker for today's webinar, Mr. Huzefa Abuheba. Mr. Huzefa is a seasoned tax expert with 11 years of experience across various industries in UAE. He excels in managing VAT and excise tax, ensuring compliance with regulatory standards, and achieving successful outcomes in tax audits, refunds, litigation. Known for his strong communication and leadership skills, Josefa consistently delivers results that ensure full compliance for the clients, making him a valuable asset in the field of taxation. So before we dive right into the session, I would encourage everyone in the audience to please share your questions in the Q&A section, not raise your hands, because if you write your questions in the Q&A section, it will help create us an interactive session, and Mr. Josefa will be able to answer your questions. And please write your questions down, as your participation is essential to the success of this event. Now, I would like to hand over the stage to Mr. Josefa, and I'll request him to commence the webinar. Over to you, Mr. Josefa.
Thank you, Hajra. Hello, everyone. Good morning. Thank you for attending today's webinar. Today webinar topic actually is all the new topic. So basically, every year on this time, like Jan, Feb, many companies are receiving audit notification from Federal Tax Authority. So it will be good that we always remind each other about the importance of tax compliance and how to be prepared for tax audit and the importance of record keeping. So today we will be discussing multiple topics, including record keeping requirements, also the requirement to amend the data kept with FTA, also the VAT pre-audit and health check, in case there is errors, what is the penalty for voluntary disclosures. We will also discuss the FTA audit procedures, also the right of taxpayer during the audit conducted by FTA, and also the cases of tax evasion, and in case of tax assessment, what could be the appeal steps. So let's get started and moving to next slide. Okay, so in the beginning, we will be discussing regarding the record keeping requirements. So as we know that record and books in relation to business must be kept in the record of any taxpayer of any companies. The law give examples of what could be the requirements for the record to be kept by each company, but this is, for example, this is not, like for overall the requirements. So for example, businesses must, maintain financial statements. This is include balance sheet, income statement. Business also must keep record of the wages and salaries as well as fixed assets. Inventory list as well must be kept by businesses. So in general, businesses are required to maintain financial statements on one aspect, and also any other commercial documents related to those transactions on the other hand. Moving to next slide. So tax procedures law stated as well that you must keep the correspondence, invoices, and contracts related to your business, as well as any documentation related to any elections made by the taxpayer. elections made. So mostly this is coming in corporate tax when you are making elections, but also in VAT there is few elections like profit margin scheme. So in case, for example, businesses elected or choose to proceed some transactions based on profit margin scheme, so they must keep the record to justify those transactions as well as the contracts. So, for example, when it comes to supply of services, export of services, so the proof of those transactions mainly are contracts and agreement, because there is no such official documents from customs regarding those transactions. So, such contracts must be maintained. Also, examples of transaction documents, like when we are talking about the export of goods, so businesses are required to maintain official and commercial documents such as invoice, packing list, custom declaration, bill of lading, exit certificate. Based on the new changes, there is also additional requirement or optional requirement to maintain the destination country import documents. So these businesses are required to keep. This is along with your financial statements. We understand the difficulty some small businesses are facing to maintain books of account or regular books of accounts. But what we are saying now, this is no longer leverage or optional, because now with the implementation of VAT, excise, and now corporate tax in UAE, it become an essential to maintain books of account, regular books of account, and to maintain financial statements along with supporting document of all your transactions. We understand that audited financial statements are not mandatory as per the tax regulation, unless for corporate tax company turnover is exceeding 50 million. However, it's advisable as well to maintain audited financial statements. This will ensure transparency of the financial statements the company is maintaining. The penalty associated with the failure to maintain books of account actually is 10,000 dirham for the first time, and if it's repeated, it will be 20,000 dirham. And it's worth to highlight, we have seen like sometimes FTA visiting a company and asking for the record, and the company failed to provide the record, and FTA imposed 10,000 dirham penalty, and they are coming again after some time and again asking for the record, and when the company failed to provide, they imposed another 20,000 dirham penalty. So this is very crucial point and important for any startup or any small businesses, that keep in your mind that whenever you are starting your business, to maintain books of account, it's either you hire in-house accountant or outsource it, but this is essential to keep it, to avoid potential penalties, and also to support your business, because definitely this will help you to know more about your business when it comes to profitability and other numbers. Moving to next slide. So today's first poll question we have: how long must taxable person maintain the tax record in UAE? So everyone, we have 30 seconds to answer. We can see more responses are coming. We hope everyone to participate. I think for this question there is no wrong answer. All possible. Yes, so time is out. Thank you everyone for participating. So for this question, moving to next slide, actually what I was saying, there is no wrong answer, because actually there is requirement to maintain your books of account for 5 years. Also, there is requirement to maintain your books of account for 7 years. Also, there is requirement to keep it for 15 years, but this is case by case. So we'll be discussing it in the next slide. Okay. So in principle, as per the tax procedures law and as per the VAT law, as well as excise tax law. So businesses are required to maintain their record for 5 years. So for any company, when it comes to the VAT perspective or excise and tax procedures law, there is requirement to maintain your record for 5 years. However, in case you are dealing in real estate, there is requirement to maintain your record for 15 years. So that's why I was saying there is also 15 years, but this is when it comes to the real estate. And also there is requirement according to the UAE corporate tax law to maintain your record for 7 years. So knowing that most of businesses and companies are registered for corporate tax, so I believe that the minimum requirements to keep your record will be 7 years, with the exception of real estate, they are required to maintain it for 15 years. There is other cases which is adding additional time limit to the period you need to maintain your record, such as in case there is a dispute between the taxpayer and the federal tax authority. So company need to maintain the record for additional 4 years or till the dispute is resolved. This is one additional criteria, as well as in case the company received an audit notification from federal tax authority. So company is required to maintain the record for additional 4 years from the notification date they received, as well as we know that FTA as well required to conclude the audit within 4 years as well. But this is additional requirement, additional to the 5 years minimum requirement to maintain your record. So in case of notification, you must keep it. In case you submitted voluntary disclosure in the 5th year of a tax period, then you must maintain your record for additional 1 year. So now we are talking about there is minimum requirement of 5 years. Corporate tax stated it should be 7 years. Real estate must keep it for 15 years. In case you received audit notification, there is additional 4 years. So in short, we can say the average period to maintain your record could be 9 years. So it's worth to highlight that businesses are encouraged to think about solutions when it comes to archiving and using cloud-based archiving, because especially for large businesses, it become a challenge to maintain such record for a period of 9 years, and when it comes to real estate for 15 years. So I believe it's a good investment for businesses to invest in archiving and keeping their data, because it will help you in compliance. It's also worth to highlight that FTA has the right to ask taxpayers for any information or required data. We have seen, because sometimes companies are mixing between the FTA audit and the request of data. So there is two different things. One is the FTA audit, which can be done by audit notification or audit without notification, and there is a request of data. So in some cases, FTA is requesting information. Maybe FTA is auditing company X, so they will be sending you asking that this is your client, or for example, this is your supplier. Please give us a statement of account, or give us some invoices and all proof of payment. So in this case as well, company are obligated to respond to FTA as well. Moving to next slide. So we have second poll question today. What is the deadline to notify FTA about a change in tax record? So they have 30 seconds. So we are getting more answers. Time is out. So thank you all for participating in our poll question. So what is the deadline to notify FTA about the changes The correct answer is 20 working days. So we will see in the next slide what will be the requirements to notify FTA, as well as the grace period which FTA granted for companies to update their record. So moving to next slide. So according to the tax procedures law, businesses are required to update their tax record with the Federal Tax Authority within 20 working days from the change. Updating tax record, this is include the entity name, the address, either the official email address, as well as the trade license in case you are adding activity, removing activity, changing manager, changing the ownership structure. This is also include the legal entity type in case of the partnership agreement of unincorporated partnership, the nature of the business, especially we have seen in some cases, federal tax authority are asking taxpayers to deregister their tax profile and make a new registration when it comes of entirely change the nature of business. We have seen some companies used to be like a manufacturer of X product, and after that they are moving to a service provider or something. In such cases, FTA is asking to deregister the existing tax account and make a new registration. So this is the elements which mainly if businesses did any change, they must notify the Federal Tax Authority within 20 working days. What will be the penalty in case of the failure to notify FTA? For the first time, there will be a 5,000 dirham penalty. If this is repeated, then there will be a 10,000 dirham penalty. It's worth to highlight that there was one decision granted a grace period for companies and businesses to update their tax record without penalty, and this will expire 31st March 2025. That grace period was granted from Jan 2024 till 31st March 2025. So in case your business is late to notify FTA about any change, the time is now. Please do it now before 31st March to avoid penalty. In case your business didn't do it and after 31st March you are doing the update, so there is a potential penalty of 5,000 dirhams in case you are late of updating your record. This is very important point which we ask, in businesses, mainly different department much coordinate and update like the tax head or the finance team with any update, because we have seen in multiple cases there is some changes happened. However, like the admin department or operation department did not notify the finance team or the tax team about this update, which will cause the delay or the failure to notify FTA within 20 working days, which will cause the imposition of the penalty. So businesses are required to ensure, harmony between different departments to ensure that the data is updated and given to FTA on time. Moving to next slide. Okay, so now this is the time we talk about the VAT pre-audit or VAT health check. So mainly we are talking about VAT health check, but this can be applied to taxes in general. So a VAT health check is comprehensive review of the organization VAT compliance, and this is to ensure accuracy, efficiency, and the compliance with the VAT regulation. This will help businesses to identify risk, errors, and potential savings as well. And when I say potential savings means if you protected your business from getting penalty, so this is a very big savings. Okay, so what is the process of doing health check and why we are doing it? So basically, most of businesses, when they are, like busy with the daily operation, day-to-day operation, there is some aspects which like businesses or the tax team, finance team are not looking into, being busy with the daily task. That's why time to time it will be good to conduct a health check to ensure that the whole system and the whole mechanism the company using to conduct to do their tax return is compliant with the federal tax authority and the VAT regulations. So basically, what we do in the VAT health check, first we need to understand the business operation. We have seen in large businesses they have different divisions. So in case of conducting health check, either in-house or by external advisor, it's very important to understand the business operation and the business flow, because this will give you an insight where is the risk areas and what could be the potential errors they are having. So also one important element is to review the VAT registration and compliance. And we all have seen the risk coming from this area is that many businesses found themselves they are registered under wrong legal type or with wrong data or unupdated data. Because of this, we understand that the tax system in UAE is considered new, and there is some elements was not important in the past but now become important, and we have to pay attention to this. So it's very important to review the VAT registration and to ensure that the companies are registered correctly, and there is no further requirements. It's worth to highlight also one of the points related to the VAT registration. I believe most of taxi groups recently received a notification from FTA asking them to review their taxi group record in case of there is duplication of entities, because we have seen some taxi group having same entity duplicated or maybe thrice in the group. Also, in case of branches, we know that branch is part of the main license. It should be under the main license and it should not be as a group member. And also, we have seen sole establishment or natural person are part of a tax group, which should not be. So this is part of updating your tax record, reviewing, ensuring compliance, and being FTA taking initiative and notifying tax groups. Now this is very good. However, businesses should ensure to review this process to ensure compliance. Also, we are doing assessment of the tax invoices and documentation. This is one of the basic elements to ensure the business is issuing tax invoices in the correct format. We have seen sometimes businesses are using, online platform or some softwares which issuing the tax invoice is not in the best format, and businesses mainly relying on that software without verifying that this software is generating tax invoice compliant with the law, as well as the documentation, because we have seen some businesses focus only on the invoice and payment receipt, but they are ignoring the fact of purchase order and even the communication to place this order, delivery notes. This is very important documents. We agree that this is not like the basic documents which usually required to prove the transaction. However, in case of audit or further questions by FTA, they might ask for this. They might ask for purchase order. They might ask for the credit notes, delivery notes as well. This should be available. Also, for the health check, when you are doing health check for your organization, you need to check the VAT treatment of transactions. This also will apply to the businesses which they have, different divisions, which will include different treatment for each division. Also, the input VAT recovery. This is also one of the main elements must be checked during the health check. And this is has different aspect. One of the aspect, you need to ensure the blocked or non-recoverable VAT input is not claimed. Non-recoverable VAT input such as entertainment expenses, such as the vehicle purchase or lease which available for personal use. So we need to ensure such expenses are not claimed. Also, the non-business related expenses, you need to ensure this is not claimed. Also, on the other hand, in case your business is generating exempted supplies, you need to ensure that you block the expenses which is attributable to exempt supplies, as well as you need to check your common expenses, which like participating in the overall organization revenue. You need to check the recoverability percentage and ensure correct allocation. And definitely end of the year you need to ensure the wash up calculation and the alternative method, and report to FTA in case the difference is more than 250,000. And the other point when it comes to health check, the risk identification and mitigation. So overall, when you are doing your health check, this is will identify the risk among your organization, and also will mitigate risk, because this will help you to rectify your errors and reduce the cost of having FTA audit and tax assessment. So that was overall view of the pre-audit, which uh, organization can conduct to ensure that and tax compliance in general. Moving to next slide. So the third poll question we have today is, when must a taxpayer file a voluntary disclosure? So we have 30 seconds. So time is out. Thank you everyone for participating. So I can see most of our audience choose when an error is found in a tax return, tax assessment, or refund request. So this answer, yes, is correct, but it's little misleading because in some cases it's not required to submit voluntary disclosure even if you found error. This is what we are going to find next in our next slide. Next slide, please. Okay. Uh, so basically, this is the cases which businesses are required to submit voluntary disclosure, mainly if business found an error. This means this error must be corrected, and the correction can be either you must submit voluntary disclosure, or you may submit voluntary disclosure, or you must correct it, or you may correct it in the current tax period. So first thing, if error are found in tax return or assessment leading to underpaid tax, voluntary disclosure is required. So in case you underpaid your tax, voluntary disclosure is required. However, it's worth to highlight in the tax procedures executive regulation, it's mentioned there that if the error is less than 10,000 dirhams, that amount, then you are allowed to correct it in your current tax return, and there is no requirement to submit voluntary disclosure. Only voluntary disclosure submission in case of error less than 10,000 dirham is required in case business does not have subsequent VAT return. So let's assume there is a business going for deregistration. You submitted your final tax return. After that, you realize that there was one error, let's say cost like VAT amount 5,000 payable tax. Then in this case, there is no further VAT return is to be submitted, so you cannot correct it in the current return. Then you have to submit voluntary disclosure. But other than this, in normal case, if the business is still in continue and you have subsequent return, if you discover an error less than 10,000 dirham, then you can correct it in the current return. Only if you discover an error is more than 10,000 dirham payable tax, you must submit a voluntary disclosure. Also, if the error in refund application result in overestimated refund, a voluntary disclosure is required. Again, also overestimated refund means you claimed tax more than what it should be. Then again, you are in payable position. So if it's less than 10,000, you are allowed to correct in the current return. If it's more than 10,000, you have to submit voluntary disclosure. Also, taxable person may submit voluntary disclosure for error causing overpaid tax. So this is the cases where you overpaid the tax. So in this case, actually, you have to submit a voluntary disclosure to reduce your payable tax. And the law stated that this is it might be submitted, so it's an optional, it's not mandatory. So basically you overpaid tax, so you have the option either to submit voluntary disclosure to claim whatever overpaid tax you did, or you can ignore it. And also taxpayer may submit voluntary disclosure for error resulting in underpaid refund. Same criteria in case you claimed less VAT input. So, or let's say you forgot to claim some invoices, then you must submit voluntary disclosure to claim this. Also, it's worth to highlight the criteria of claiming the VAT input, because there is some confusion about, like the error of forgetting to report VAT input or claim invoice, and the time frame to claim the VAT input. So basically, the time frame is it should be within two tax. Okay, so the time frame is the claim of VAT input. It should be within two tax periods where the two conditions of claiming VAT input are satisfied. First condition is to have the tax invoice. When I say have tax invoice, means a proper correct tax invoice. Number second condition is paid the value of the amount of the tax invoice or intention to make the payment of that tax invoice within 6 months from the due date. So as long as these two conditions are satisfied, you are allowed to claim the VAT input during the tax period where both conditions are satisfied, or maximum subsequent tax period. So this is your right to claim the VAT input. This is different from you forgot. So let's say these two conditions are met and you forgot to claim your VAT input. Then in this case, to claim it, you must submit voluntary disclosure in the tax period where both conditions were satisfied to claim this invoice. Also added to this voluntary disclosure criteria, there was a new decision number 8 of year 2024, issued by FTA, which require to submit a voluntary disclosure in case there is no tax impact. So this decision is effective from Jan 2025. However, till now, the in system in Emara tax portal system is not allowing to submit a voluntary disclosure with no tax impact. However, the law stated that you have to submit it. So we expected that shortly FTA will be allowing this in the system. So mainly the decision number 8 of 2024 require in case you have an error in the emirate reporting. So basically you are reporting the standard rated sales based on the fixed establishment, or let's say the place of establishment of your company. So in case you misreport the emirate wise, and also for the electronic for the e-commerce companies where their turnover is more than 100 million, it's required to report based on the customer location. So in case you misplace the reporting for emirate wise, you must submit a voluntary disclosure to correct it, as well as the misreporting of zero rated sales and exempted sales, either overestimated or underestimated. You must submit voluntary disclosure. This is based on decision number 8 of year 2024. However, the implementation of this decision yet to happen. Till date, in Emara tax portal system is not allowing to submit this. Moving to next slide. Okay. So basically, we discuss about the health check. We encourage companies to have an health check either in-house or using third party. And also we discuss the requirement to submit voluntary disclosure and when you can adjust it in your current return. Now we are discussing the penalties which is going to be imposed in case of voluntary disclosure. So in case you discover an error and this error require voluntary disclosure, uh, and you submit voluntary disclosure, the penalty will be, there is two penalties. One is fixed penalty and one is percentage penalty. The fixed penalty will be 1,000 dirham for the first time, 2,000 dirham if it's repeated within 24 months. And for the percentage penalty, it depends on within how many years you are submitting the tax return from the tax period. So if you are submitting voluntary disclosure within 1 year of the tax period, so there is a percentage penalty of 5% of the tax amount. If you are submitting within 2 years, then there is a 10%. 3 years, it's a 20%. 4 years, it's 30%. 5 years onward, it's 40%. However, there is no beyond 5 years because the law institute of limitation, the law state that maximum within 5 years you can submit voluntary disclosure. So this is the percentage penalty of submitting voluntary disclosure. It's worth to highlight that those penalties are for the payable voluntary disclosure in case you are increasing your claim. So there is no percentage penalty, only there will be a fixed penalty of 500 dirham. Also there is yeah, so it's only 500 dirhams, the fixed penalty in case you are submitting voluntary disclosure in claim position. But if it's in payable position, this is the percentage of penalty. So by reaching to penalties, we concluded the steps of doing the health check and the requirement of voluntary disclosure, and also what could be the possible penalties for voluntary disclosure. Moving to next slide. Next slide, please. Okay. Um, so now we will be discussing regarding the FTA audit. So what is the tax audit? Why FTA is conducting audit? What is the requirements during the audit? And also, the right of taxpayer during audit. And also we will discuss the penalties in case of tax audit and getting tax assessment. So basically, what is tax audit? The tax procedures law define tax audit as a procedure undertaken by FTA to inspect the commercial record or any information or data related to a person conducting business. So this is as per the tax procedures law. Why FTA is conducting an audit? So FTA conduct an audit to inspect the level of adherence to compliance with the tax law. The audit also involves factors such as the risk profile of the taxpayer, the nature of business, and place of business conducted. So basically, the Federal Tax Authority is the body who is ensuring compliance of the tax regulation in UAE. So they are conducting an audit to taxpayers and the businesses to ensure the compliance with the tax regulations in UAE. Companies can fall under the FTA audit for multiple reasons and elements. One of the reasons is the high risk industries. So we agreed that, we all agree that there is some businesses like having a high risk more than other businesses. So those businesses are like having a high potential to get an FTA audit. For example, we know that for when it comes to for excise tax, we know that like tobacco industry, it's a high risk business and it's like always subject to audit by FTA. When it comes to VAT, we know businesses like logistics companies, transportation companies as well. So basically, some businesses, the nature of it is including a high risk. So this also having a high potential to have an audit by FTA. So for FTA, when they do audit, what they do basically they do examination of the records. So they are requesting taxpayers to provide the record so they can do an examination. They also ensure the adherence to the VAT law. They make sure that the tax treatment was applied correctly for the company and the business transactions. And also they ensure the tax liability is paid and also correctly reported to FTA. Moving to next slide. So the fourth poll question we have today is what is the minimum notice period that FTA must provide before conducting a tax audit? So time is out. Thank you all for your participation. So most of you got the answer correctly. It's 10 days. And actually that was extended before it was 5 days. Now it become 10 days. So moving to next slide. Okay. When it comes to the audit process and what is the procedures that FTA follow when it comes to audit? So first thing that FTA must notify the taxpayer of the audit, and this notification should be at least 10 working days period the audit commence or the start of the audit. Also, it's worth to highlight that as per the tax procedures law, FTA may start an audit without notification. This can be in, like certain cases where FTA having grounds to believe that, there is tax have been evaded, or there is some risk associated with this business transactions. So they might start an audit without notification, but still, if they start an audit without notification, they must provide the company or the business with the audit notice once they arrive to the premises. So in general, when it comes to the start of audit by Federal Tax Authority, it should happen with audit notice. If it's in the normal cases, the audit notice must be sent at least 10 working days prior to the commence of audit. In some cases, they can start an audit without notice. However, they have to give the audit notice to the taxpayer once they reach to their premises. Also, FTA has the right to temporarily close the business premises or the office for 72 hours to conduct an audit. This can happen in some certain cases. Number one, if there is grounds to believe that tax has been evaded, or the not temporarily closing the place will hinder the audit process. So maybe FTA will believe that if the place remain open, they cannot, for example, control the data is there, or the goods available in that place, or maybe this place, does not have a proper like security measures, whatever. So maybe FTA will decide to close the business premises for 72 hours. And also, if the person who received the advance notice of the tax audit attempt to stop the auditor from entering the place where the audit to be performed. Also, this is one of the reasons that FTA can close the premises. Moving to next slide. Okay. So when it comes to the audit process, so now we know that it's either FTA will give you an audit notice, and this will be at least 10 working days period the start of audit, or FTA will come for sudden audit. So what FTA will do? So now if FTA send the audit notice, and usually this audit notice will be followed with list of requirements. So now we have two taxes. We have VAT and we have excise goods. I will briefly give you an indication of what is the requirements which FTA is asking when it comes to the audit. Your business should be ready for these requirements. And also it's very important to know that FTA is giving 10 working days to receive this data. So I believe it's not possible to prepare all of those requirements within 10 working days. So businesses should be ready from now, not when they receive the requirement list. So when it comes to VAT, Basically, FTA is asking, list of your sales, and this list must include certain information like, the invoice number, invoice date, amount, tax amount, customer name, customer TRN, and description of the supply the company made. This information all must be available while you are providing list of your sales. Also, FTA is asking list of expenses, which must include as well supplier name, supplier TRN, description of the item purchase, invoice number, invoice date, invoice value, and the tax amount and the recovered amount. Those informations must be available when you give the expenses list, as well as FTA is asking to provide list of your import. It's either import of service or import of goods. So, and those import transaction must be supporting with documents. FTA is asking for the zero rated sales, exempted sales, and they are asking for the supporting documents as well. So this is the primary information that FTA is asking. FTA is asking also for periodic trial balance. So in case you are having monthly VAT return, you might get a request from FTA to provide them with monthly trial balance. If you are having quarterly VAT return, you might have a request to provide quarterly trial balance. This is also one of the requests by FTA. FTA also requests audited financial statements if you have it, if it's available. And as I mentioned, because the tax procedures law does not mandate to perform an audit, financial audit, so this is not mandatory, but it's highly appreciated by FTA auditors if the company is having audited financial statements, because this is giving more trustability in your statements and figures. This is also FTA is asking. Also, FTA is requesting VAT, or let's say revenue reconciliation. This reconciliation is a comparison between your trial balance revenue and your tax return revenue, and you must justify those differences coming from where. And definitely there should be, a legal ground of the reasons behind of these differences. This is mainly the basic information which FTA is asking. Further to this, FTA is requesting additional information based on the data you provided and the sample selections. So this is mainly the information which FTA is asking when it comes to VAT. When it comes to excise tax, it's having, different nature of requirements. Uh, but again, FTA is asking number one, and the essential information FT is asking is the stock movement. And as we know that like stock movement for excise tax is like trial balance for VAT. That's why it's very essential when it comes to excise tax. So stock movement FT is asking in case you are in manufacturing production, they were asking for production report, consumption report, and also if you are having a designated zone, they are asking for designated zone transactions. Also, they are asking for sample documents. Case you are having designated zone, FTA is asking for audited stock report. So assuming that you are conducting audit, periodic audit for your designated zone, in case also you are, subject to audit for the period of 2017 or 2019. So there will be a question of stockpile calculation FTA is asking. So that was briefly the information that FTA is asking in case you are subject to excise audit, and also in case you are subject to VAT audit. So it's also worth to highlight that FTA may conduct an audit again based on the availability of new information, because some businesses, for example, they already had an audit for certain tax period, and for example that audit was like no findings, or maybe there was some findings, and then businesses are saying okay, done, chapter closed. But actually chapter is not closed, because FTA may reopen again an audit for the same tax period in case they have new information related to the business, so they can reopen an audit based on this new information. Also, it's worth to highlight that the auditor can obtain original records or copies and take samples of goods or assets from the business location. So, in case of you are having a visit from FTA auditor during the audit, he might ask to get the originals or take some samples of the goods you have during the audit process, and definitely these mostly are returned after concluding the audit. So basically that was an overview of the requirements of tax audit and the list of requirements which FTA is asking when they are conducting an audit, either for VAT or excise tax. Moving to next slide. So what is the rights of taxpayer who is under audit? So number one, taxpayer has the right to ask the tax auditor to show their job identification card to ensure that you are dealing with one of FTA auditors. Number two, taxpayer has the right to attend the tax audit if it take place outside the FTA premises. Number three, taxpayer has the right to obtain a copy of the tax audit notification. And as I mentioned, in case of the audit which start with prior notice, you are going to receive this notification ahead at least of 10 working days. But in case of audit without notification, that will be a sudden audit. However, you have the right to obtain a copy of this audit notification when they visit your premises. Also, FTA, as we discussed, must notify the taxpayer at least 10 business days prior to the audit. And also, a taxpayer has the right to take copy of any original documents seized by FTA during the audit. So those was like the taxpayer rights during the audit. Moving to next slide. Okay. So now we started the FTA audit, and we already shared with FTA the list of requirements. And when FTA is concluding the audit, we have two options. One is FTA might issue like the tax assessment under no findings. They will state that like no findings found. This means your business is in compliant and there is no errors or findings has been noticed. Other way is FTA will find some errors, and which will result in either underestimated tax or overestimated tax paid, and then they will issue a tax assessment. So what is the cases where FTA will issue a tax assessment? First case is when taxable person failing to apply for registration within the time frame specified by the tax law. So this also a very important concept, because some individuals or business, they think that if they are not registered in tax, they wouldn't get an audit for that tax, which is a wrong assumption. Why? Because FTA might conduct an audit even though if you are not registered. Let's say if you are not registered, and you might receive a random notification from FTA asking you to provide your bank statement or to provide your financial statements. They can ask you why you are not registered. Then you have to justify this. This, by the way, can happen to either individuals or businesses, because again, we have seen some individuals are conducting business in their personal capacity, thinking that they are not required to register because they don't have license, which again also this is not the right thing. Because if you are conducting business, even though it's in your personal capacity, but still you are conducting business, so you must register in VAT and follow the regulations, despite the fact that you are doing this without license, which might be not the right thing to do from the license authority perspective. But when it comes to tax perspective, as long as you are doing business, even though if it's in your personal capacity, then you have to register for VAT. So if taxable person failing to apply for registration within the time frame, he might be subject to a tax audit. And also if register failing to submit tax return within the time frame, we have seen sometimes some companies, due to reason or other, they stopped submitting their return, or they they are not aware that they are required to submit their tax return. So most likely these businesses are subject to an audit to find out their tax dues. Also, the other element that register failing to pay the tax is stated as payable tax on the tax return. So, if businesses who are not paying the tax payable on time, they might be subject to a tax assessment. Also, the taxable person who is submitting an incorrect tax return, this is also will be subject to tax assessment issued by FTA. It's also worth to highlight that some businesses or individuals might be subject to estimated tax assessment in case of the non-availability of documents, because for in some cases, like businesses for example, they do not have sufficient records, they do not have documents to justify their operation or business transaction. Then in this case they might be subject to an estimated tax assessment. So this is the cases where tax assessment might be issued. So in case of failure to register or failure to settle the tax payable or filing incorrect tax return, those are the cases which you make taxable person or businesses are subject to tax assessment. Moving to next slide. So next poll question we have, what is the penalty for failing to submit a voluntary disclosure when required? So we have 30 seconds. Remember, we discussed earlier what is the penalties in case you submit voluntary disclosure. So what if you fail to submit those voluntary disclosure? What could be the penalties? So thank you all for your participation. I can see that there is more answers this time, so I believe that was easy question. Okay, so yeah, the most of you answered that there will be a fixed penalty percentage based penalty as well. Yes, this is correct. So let's find out like how much will be. Moving to next slide. Okay, so in case of the issuance of tax assessment from Federal Tax Authority, there will be penalties. Those penalties are fixed penalty and percentage-based penalty. The fixed penalty will be 1,000 dirham for the first period and 2,000 dirham for subsequent periods. The percentage penalty will be, one is 50% of the tax amount plus 4% on monthly basis from the tax period till the tax assessment issuance date. So this is the penalties the business is going to get in case of issuance of tax assessment. The maximum of those tax assessment penalty will be 200%. Fixed penalty, we said 1,000 first time, 2,000 subsequent times. And percentage penalty will be 50% of the tax amount plus 4% on monthly base from the tax period till the tax assessment issuance date. This penalty is capped with 200%. So if you compare this penalty with voluntary disclosure penalty, you will find out that this is a way too more, because for voluntary disclosure, maximum penalty if you submit within 5 years, penalty percentage is 40% only. But for for tax assessment penalty, it can goes up to 200%, which is like, way more than the voluntary disclosure penalty. That's why we always emphasize the importance of businesses to, conduct their health check, correct their errors, because this is a way better than waiting for tax assessment, which will cost you time and money as well. Moving to next slide. Okay. So we were talking about like errors and voluntary disclose your error or having a tax assessment and administrative penalty. In this slides, we are talking about tax evasion. So there is some cases where the tax procedures law stated that those can be considered as tax evasion, which will be subject to different penalties, which can be maximum 300%, and also there can be a jail penalty for the concerned person when it comes to tax evasion. So what could be under tax evasion? Number one is deliberately failing to settle any payable tax. So in case the business is like collecting taxes and all, but deliberately not settling this tax, this can be considered under tax evasion. Number two is deliberately understating the actual value of the business or revenue, or failing to consolidate his related businesses with the intent of remaining below the relevant registration threshold or tax rate or tax registration threshold. So in this case, in case you are underestimating in case you are understating your actual value of sales and revenue, just for the reason of getting some tax advantage, or if you are not consolidating your revenue, like let's say for example you are having multiple sole establishments, but you are maintaining separate registration for each sole establishment, and so this is something can be falling under the tax evasion cases. And definitely, if you are underestimating your revenue, this will be falling under tax evasion cases. Third point is deliberately imposing and collecting amount of tax without being registered. This is very important point because we have seen many businesses, especially startups, they are doing it by mistake. They are not aware that this can be fall under tax evasion. So by nature, someone started business and they start to issue invoice. They issue a tax invoice, they collect the tax without being registered in tax. This is not a good practice to do. So if you started a business, first I would advise to check with tax consultant, but in general, you must first reach to the registration threshold, and then after being registered in VAT, you can start to issue a tax invoices and collect tax. Collecting tax without being registered might make your business falling under tax evasion. Fourth point is deliberately decreasing the due tax or participating in any form of tax evasion. So this is also falling under tax evasion. Like if you are trying to decrease your tax by a way or another. Also, deliberately committing or omitting any other facts which may constitute a tax evasion. In case you are, like hiding some facts or information from FTA to, like less paid taxes, this can be considered as a tax evasion. Moving to next slide. Also, it can be considered under tax evasion, deliberately providing false information or incorrect data to FTA, and also deliberately concealing or destroying documents and information that is required to keep and provide to FTA. So in case you are having an audit and then like whatever data you have, if you intend to destroy it for the sake of not giving to FTA, this can be falling under tax evasion, will be makes you and the business subject to tax evasion rules, which can be heavy penalties and jail sentence as well. Also, stealing or destroying documents or other materials that in possession with the FTA. In case FTA confiscated some goods or seized some data, this can be considered as tax evasion. Also, deliberately preventing or hindering the authority from performing their duties. This can be falling under tax evasion as well. So those were the cases where if you are committing, this might be falling under tax evasion. Moving to next slide. So next poll question we have, can a business challenge an FTA audit findings? So you have 30 seconds. 3 seconds. And time is out. Thank you all for your participation. So yes, can a business challenge an FTA audit findings? Answer is yes, either through tax assessment review or reconsideration. Moving to next slide. So this will be the last slide in today's webinar. So we will be discussing about the appeal stages. So basically, we discussed regarding the tax audit, and in case FTA is issuing tax assessment, we discussed the potential penalties businesses might get, which can be up to 200% plus the tax amount as well. So can businesses challenge or object the audit findings? The answer is yes. So first stage, and by the way, this is optional stage, you can apply for tax assessment review within 40 working days from the tax assessment issuance. So within 40 working days, you have the right to submit a request to FTA as a tax assessment review to reconsider the tax assessment they issued. And this is optional stage. Second stage is submit a reconsideration request. So reconsideration request either submitted within 40 working days from the tax assessment notification or within 40 working days from the tax assessment review decision. So businesses have the option. It's either to go for tax assessment review first, and then after that, if they are not happy or satisfied with the outcome, they can go for a reconsideration. The other option is directly after the tax assessment issuance, businesses can go for reconsideration within 40 days. And after the reconsideration, if you are not getting favorable outcome, businesses can go for TDRC, Tax Dispute Resolution Committee. You can file the request within 40 business days as well. And based on the outcome from the TDRC committee, you have the right to go for court appeal. So you can start with first instant court or Supreme Court as well. So this is the appeal steps or stages. In case any business is subject to tax assessment, you can challenge these findings, and either you go for reconsideration till going to the court. So by reaching to this part, I concluded my presentation for today. So I hope that was very insightful for everyone. And so basically today we discussed briefly about conducting about the record keeping requirements, also the requirements to notify federal tax authority with any change happening in your business, which should be within 20 working days. Also, we discuss about the importance of conducting health checks, either in-house or with third party, to find out your errors and to ensure compliance, and to submit voluntary disclosures if required. Also, we discuss the FTA audit and what is the requirements. Mainly, FTA is asking to do an audit, and also what is the penalties in case of issuance of tax assessment. Also, we discuss about the cases of tax evasion, as well as what will be the appeal steps in case of tax assessment. So thank you all, and we can move now to Q&A session.
Hello, everybody. Good morning. So we have a few questions in the chat box. I request all the participants to type in any questions if you have anything. Meantime, we will go with the questions one by one. So we have a question from Mr. Manoj Pereira. Can we ask for a further extension other than the 10-day working period? This is, I think, with respect to the notice for the notice the registrants get before tax audit.
Okay. So thank you for the question. So yes, you can ask for extension when it comes to the 10 days FTA is giving to request the information. Even after that, FTA usually is giving 5 days to provide subsequent data. You can ask for extension. However, the faster you provide the data, the better for the business. Because if you remember the tax assessment penalty is percentage, which is 50% plus 4% from the tax period till the tax assessment issuance date. So the longer the tax audit takes, the heavier penalty businesses might get. So, in my opinion, the quicker you provide the information to FTA, the better for your business. So, in case of any errors found by FTA, then they will issue the assessment. You will be getting, less penalty than taking longer time. But yes, you have the right, and you can ask for extension.
All right. Moving on to the next question. We have question from Carlota. If our sales is out of scope, do we have to submit the tax invoice as well, or commercial invoice is enough?
Okay, so as per Article 59, the tax invoice requirements, if the whole supply is subject to zero rated tax, then and there is alternative document to prove the transaction, then there is no requirement to issue a tax invoice. So to answer your question, if you are conducting out of scope transaction, yes, you can issue a commercial invoice only, and there is no requirements to issue a tax invoice.
All right. We have another question from Mr. Zaid. Is the audit process for both VAT and excise tax?
Sorry, again?
Yeah, sorry. Is the audit process for both the VAT and excise tax? He's asking
Uh,
whether, yeah, this
okay.
audit process is similar for both VAT and excise tax. Yeah.
Okay, so basically the tax procedures law actually is covering all taxes, even this is cover corporate tax. So whatever timeline, time frames, the rights of FTA, the right of taxpayers, the appeal steps, the penalties. There is some penalties only for corporate tax that was based on another decision issued for corporate tax penalties, but mainly the tax procedures law is covering all taxes, so the process is the same either for VAT, excise, or even corporate tax. Definitely requirements can be different. As I mentioned, for excise they will be asking for stock movement, but definitely in VAT there is no request for stock movement. But end of the day, the tax procedures law is the same. Requirement will vary from tax to another.
All right. Moving to the another question.
Yeah.
We have a question from Miss Ashina Achi. What is the time period for claiming refund? Our company management has not claimed refund since 2021. We have more than 1 million refund. Please help with this process.
Okay, so in the VAT laws, there is no time limit stated that within how long a company or business must apply for the refund. So I would assume that you can apply for refund now for that period. And actually, in some stages, if they is taking the initiative, when they find out there is some businesses they have credit balance, so if they is sending notification asking them what is the reason of not claiming this refund amount, and sometimes they are asking them for the breakdown and all. But there is no time frame or time limit to claim the refund under VAT law. So if you have accumulated refund amount in 2021, you can submit now. It's worth to highlight that for excise tax law, actually there is time limit. It is stated there that within 5 years you can apply for the refund. But in VAT laws, there is no time frame. Thank you.
All right. We have a follow-up question from Mr. Zaid. For the penalty, can you repeat the part how you calculate? Is it calculated?
Which penalty, voluntary disclosure or tax assessment?
He hasn't mentioned that
Okay,
exactly. Let's wait for that. Okay.
no
Uh, we
issues.
ha yeah. We have another question from Mr. Akil Bozo. Is it necessary to update and notify license renewal in the FTA?
Yes, it's essential and important to always maintain and valid documents with FTA. So in case of the expiration of trade license or owner documents like passport or Emirates ID, it's essential to update it with FTA.
All right, moving on. We have another question from Miss Femida. We are a VAT registered company. Can we buy or sell goods to businesses that are not VAT registered and claim input/output VAT? Or does this attract some penalty from the FTA?
Okay, in general, the tax, the tax rate and charging tax does not impact or has no impact if you are selling to registered or non-registered. So if the goods you are selling subject to 5% tax, so either you sell it to registered person or business or to unregistered business, still you have to charge 5% tax. Okay. Now when it comes to purchases, so if you are doing purchases from non-registered supplier, still it has no issue because this business or this supplier might not be registered because he is not reaching the threshold, right? So buying from unregistered supplier still fine. There is no issue on this. However, to mitigate risk, you might ask a confirmation from your supplier, you might ask a confirmation from your supplier that the reason why they are not registered, because in case your supplier is eligible for registration and he's not registered, he might come later after some time and ask you like, I supposed to charge VAT and all. Then you will go in this dilemma. So it's better if you are dealing with non-registered businesses to ask for them like kind of confirmation that they are not registered, the reason of non-registration, and also you might ask them to confirm they will not come in the future to claim any taxes from you. But there is no issue to deal with non-registered businesses because VAT has a threshold of registration. Some business might not be reaching this threshold.
All right, thanks. Moving on, we have another question from Mr. Guruganan. Our company only changed the rest of all the assets details are the same. In this case, do we need to complete voluntary disclosure?
Sorry,
Maybe
what they did?
yeah, maybe the question is not clear.
Hmm.
We'll get into another question. We have another question from Miss Marisol. Can we use the recoverable VAT as a payment for CT due?
Okay, so recoverable VAT is not a deductible expense for corporate tax. Okay, so this is one of the non-deductible expenses, which is the recoverable VAT, which it makes sense because you are claiming this VAT, so you should not consider it as expense for corporate tax. So recoverable VAT is not deductible expense for corporate tax.
All right. So we have a follow-up question from Mr. Zaid. If I submit audited financial statements for Talal Abu Ghasal, they will still ask me for a proof for the sales, expense, and purchases. And regarding the penalty explanation he requested, he's asking for penalty for voluntary disclosure. He wanted to
Okay.
yeah.
Okay, so first thing, the audited financial statements, in my opinion, regardless from where that was audited, regardless the name who audited these financial statements, still FTA are going to ask you for ledgers and breakdown and details. So only audited financial statements, in some cases it's required by law. Maybe like if you are in a free zone or something, there is a requirement to submit yearly audited financial statements. Corporate tax law, if your revenue more than 50 million, you have to provide audited financial statements. But despite providing these audit financial statements and regardless the name who did this audit, FTA is still asking for breakdown and ledgers. And to the other question, when it comes to the penalty of voluntary disclosure, if you are so there is fixed penalty which is 1,000 for the first period, 2,000 for subsequent periods, plus percentage penalty. This percentage penalty, it depends on within how many years from the tax period you are submitting the voluntary disclosure. So if you submit voluntary disclosure within 1 year from the tax period, then the penalty will be 5%. If you are submitting voluntary disclosure within 2 years from the tax period, then penalty will be 10%, and so on up to 5 years, which will be 40%. So it depends on within how many years from the tax period you are submitting your voluntary disclosure.
All right, sir. So the question which was not clear asked by Mr. Guruganan, he has followed it up. What he's asking is the name of the company only changed. The rest of all the shareholder details are the same. In this case, do we need to complete voluntary disclosure?
So I believe he meant to submit an amendment to update the record with FTA, because
Yes.
voluntary disclosure is mainly you have to submit in case you have an error in your tax return. But changing the company name, this require to submit an amendment request to FTA to update your record.
All right, so moving on, we have a question from Mr. Fernando. VAT introduced in UAE on 1st Jan 2018 onwards. Today we are in early 2025. It means 7 years already completed. May I know, can FTA call for VAT audit for the year 2018 right now?
Um, okay, so yeah, there is some cases they can ask for audit up to 15 years. So in case FTA believe that there is tax evasion happening, they can open the record up to 15 years. This is number one. Number two is FTA, in case they sent you an audit notification, they have the right to conclude this audit within 4 years. So I would advise to check if you received an audit notification or not, because we have seen this in multiple cases. Businesses think they are not subject to audit or they are not under audit. However, with a small search in the emails, they find out they received already audit notification. In many cases, this audit notification is received in Arabic. That's why also for non-Arabic speaker, they are ignoring those emails. So I would advise to check the emails to see if the company received an audit notification. If yes, then FTA has the right to conclude the audit within 4 years from the audit notification. But if no notification and 5 years is already passed, then FTA should not be able to open an audit for that period unless they believe there is tax evasion. Then they can open up to 15 years.
All right. So we'll take one final question.
Yeah.
We have a question from Mr. Mubarak. With the introduction of corporate tax, there is all sort of cross-charging happening between related parties. Some of them are not part of the VAT tax group. From a VAT tax standpoint, how do you see this? The FT will be also aware of this trend, and what are the common mistakes you normally see happen?
Okay, so basically, when it comes to cross charging, if the businesses are not part of that group, so this cross charging should be subject to VAT, depends on the nature of service or the cross charge you are making. Because these two entities are related party, but actually they are not part of a VAT group, so they must charge VAT on their transaction. And the common mistakes I'm saying that sometimes businesses or related parties, they think that they are related party, and it's like one pocket, so it doesn't matter who receives the invoice, who makes the payment, related to whom. But there should be some awareness about being related party does not mean you are one person for tax purposes. Unless you form a tax group either for corporate tax or VAT, you are different legal persons, and you must do your transaction based on the tax regulations. So cross charging between related party which they are not part of a VAT group, it should be taxable. And being this is the last question, I hope everyone enjoyed today's session and it was insightful for everyone. And yeah, thank you for attending today's webinar. To you, Hajra.
Thank you so much, Mr. Josefa. And thank you so much, Mr. Austin, for delivering such an informative and engaging session. Big thank you to everyone in the audience for joining us today and contributing to the enriching experience. As your participation and presence has made this session valuable and impactful, we look forward to connect with you in our future webinars. And our QR code is there on the screen. Please scan it and give us a review as well. And until next time, thank you so much. And if you have any further regarding excise, VAT, or corporate tax, please feel free to drop us an email or give us a call. And the details are mentioned on the screen. And thank you so much for giving the feedback in the poll questions as well, and in the rating last poll question as well. So thank you so much. And until next time, we'll see you again in our next upcoming future webinars. Have a great day ahead to everyone.